Coinbase tokenizes its Bitcoin yield fund on Base. With Apex Group as transfer agent, Coinbase Asset Management has launched a tokenized share class of its Bitcoin yield fund on Base, its own Ethereum Layer 2 network. Apex Group, a financial services firm managing over $3.3 trillion in assets, serves as the on-chain transfer agent. The product targets 4.8% annual returns denominated in Bitcoin for institutional and accredited investors outside the United States, Cointelegraph reported on March 20th. Why Coinbase built a yield product for an asset that has no native yield? Bitcoin does not generate yield on its own. Unlike Ethereum or Solana, where validators earn staking rewards, BTC holders sit on a non-productive asset unless they lend it, use it as collateral, or deploy basis trade strategies. Coinbase Asset Management created the Bitcoin Yield Fund to fill that gap, first launching a non-US version in April 2025 and a US version in October 2025. The tokenized share class on Base is the latest extension. Anthony Basile, president of Coinbase Asset Management, said the fund integrates identity and eligibility at the token level, meaning compliance checks happen in the token itself rather than through a separate gatekeeper. Coinbase has not disclosed the specific mechanism used to generate the 4 to 8% target return. Basis trades, buying spot BTC while shorting futures to capture the premium, institutional lending, and covered call strategies are all common approaches for BTC yield products. But the fund documentation does not specify which combination Coinbase employs. ERC-3643 and why the token standard matters. The tokenized share class uses ERC-3643, a permissioned token standard designed for regulated securities. Unlike standard ERC-20 tokens that anyone can send or receive, ERC-3643 tokens enforce transfer restrictions at the smart contract level. Only wallets that pass identity and eligibility checks can hold or transfer the tokens. Apex Group handles this enforcement as the on-chain transfer agent. The firm maintains token ownership records, enforces compliance and transfer rules, and keeps transaction records on Base. In a statement, Apex Group said the system is set up to interact with compatible platforms, wallets, and infrastructure without compromising compliance. This matters because it separates two functions that traditional finance bundles together: asset custody and compliance verification. The token itself carries the compliance logic, so any platform that supports ERC-3643 can distribute or trade the fund shares without building its own KYC infrastructure from scratch. Where this fits in the tokenized fund race, Coinbase is not the first major institution to tokenize a fund product. BlackRock launched its BUIDL fund, tokenized U.S. Treasury money market fund, on Ethereum in March 2024 and has since expanded it to multiple chains. Franklin Templeton's on-chain U.S. government money fund has been tokenized since 2021. Fidelity Investments filed for a tokenized money market fund in early 2025. What separates the Coinbase product is the combination of Bitcoin yield exposure and deployment on a chain that Coinbase controls. Base is an Ethereum L2 operated by Coinbase, which gives the company end-to-end oversight of the infrastructure stack. The fund runs on Coinbase's chain, managed by Coinbase's asset arm, with a third-party transfer agent providing the compliance layer. A U.S. investor share class is planned but not yet available. Given that Coinbase already operates the Bitcoin Yield Fund for U.S. investors through traditional rails, launched October 2025, the tokenized version likely follows once regulatory approvals for on-chain distribution are secured. BTC yield in a fear market. The launch comes during a period of market unease. Bitcoin traded at $70,380 as of March 20, 2026, down 1.1% over the past 24 hours, and the Fear and Greed Index sat at 31, fear. BTC is down 1.7% on the week. For institutional allocators, a 4.8% annual BTC yield product becomes more attractive in sideways or declining markets because the yield offsets some of the price risk. A holder earning 6% annually on BTC needs the price to drop more than 6% before they lose money in BTC terms. That does not eliminate drawdown risk in dollar terms, but it changes the math compared to holding spot BTC with zero income. The tokenized format on Base also creates composability options that traditional fund structures lack. ERC3643 tokens could theoretically be used as collateral in DeFi protocols that support the standard, though no such integrations have been announced.